Hello, hello, hello. Good morning, good afternoon, good evening, depending on your time zone. Welcome to my channel. My name is Ogbanje Joseph. Please subscribe to this channel, share, like, as well as drop a comment on the comment section. So, our lecture today is titled Third World and Foreign Debt. Third World and Foreign Debt. Now, the burden of external debt, of the third world countries is a serious problem because these countries depend heavily on the inflows of capital from abroad to finance their developmental needs. According to Ibrahim 2015, being poor countries, the third world countries relate, rates the poor countries' rate of domestic savings and investments are low. Now, the issue of debt is one that is inherent in the international economic relations. Now, even though no nation wants to be a debtor, but some internal or domestic forces compel nations to be indebted, especially to the IMF, World Bank, and sometimes these loans are used for developmental purposes, but at other times they are siphoned by public officials. Okay, now let us look at the concept of debt. What is the concept of debt? Now, according to Aja 2002, the debt can be defined as a sum of money owed a person, institution, or a state. Now, it is a financial obligation entered into with a view of paying of paying back at a later date. Nabon 2010 defines debt as when something, usually money, is owed by one party, creditor, by one party, that is the borrower, or debtor, to a second party, which is a lender or creditor. Now, debts are generally subject to contractual terms regarding the amount and timing of payments of principal and the interest. Now, the types of debt includes loans, bonds, notes, and mortgages. Now, what are the reasons? What are the reasons or basis of borrowing? Reasons or basis of borrowing. Number one, to accelerate the rate of infrastructural development. Number two, it helps in the import of capital goods, raw materials and technical know-how. Three, it facilitates finance consumer goods, or it is used to finance consumer goods, to meet the requirements of the growing population, and all of that. So now, what are the causes? What are the causes of debt crisis in third world countries? What are the causes? The causes of debt crisis in third world countries. Number one, oil price shock. Now, according to Nabon 2010, the principal cause of the international debt crisis of the 1970s and 80s was the increase in oil prices in 1973 and 1979. Now, the increase in oil price caused, a large increase in the import bills of non-oil producing countries, causing them to actually borrow. So that is number one. Number two, bad macroeconomic management. Bad macroeconomic management. Now, most third world countries think that by solving the problem of balance of payment, is to create more bureaucracy. Now, this action has continued to expand the expenditures, to meet demand for their economic development, which made them, to borrow. Okay, so that is actually number two. Number three, trade policies. Now, the less developed countries follows the onward oriented import substitution industrialization till the 1970s. Now, this policy brought initial gain, but it made the less developed countries, to abandon the agricultural sector, and as such, it made their economies open to the vagaries of the international market. The vagaries of the international market shock. Example, the 1970s and 80s increase, the 1970s and 80s increase in oil prices led to the recession in the developed countries also, and it also affected the less developed countries. Okay, so that is number 3. Number 4, rising interest rates. Now, when there was increase in the prices of oil, it led to inflation in the developed world, which translated to increase in money and real interest rates. Consequently, the cost of servicing the past and present debt increased, for the less developed countries. Now, let us look at the measures. What are the measures to reduce debt burden in third world countries? What are the measures that have been put in place to reduce debt burden in third world countries? Number 1 is twin track IMF strategy. Twin track IMF strategy. Now, according to this strategy, it would continue to give direct financial assistance, to provide time to grow out of their debt problems. And second, to encourage structural adjustment program in them to increase their debt services capacity in the long run. So that is actually number 1. Then number two is debt rescheduling by commercial banks. Now, when Mexico and other Latin American countries expressed their inability to service their debts, the international commercial banks, devised ways to avert the banking crisis. Now, the creditor banks formed, a bank advisory committee, that is BAC, known as the London Club, to reschedule debts on case-by-case basis with individual debtor countries. Okay, so that is actually number 2. Number 3, Barker plan. James Barker proposed a scheme known as the Barker Plan in October 1985, based on the fund's twin track approach. It provided for $20 billion US dollars of new loans, by banks over 3 to 15 years, and $9 billion US dollars of multilateral lending, to the 15 most heavily indebted, less developed countries. Now, in return, these countries were to undertake growth structural adjustment program, but it failed because the banks were skeptical. So that is actually number 3. Number 4, Bradley plan. Now, the Bradley plan was actually proposed by Nicholas Bradley, that is the US Treasury Secretary, in 1989. Now, this Bradley plan was actually put in place to achieve the following. Number 1, that IMF World Bank is to provide funds to debtor countries, for repayment of debt to banks. But these countries were to carry out growth-oriented adjustment program laid down by the fund and World Bank. That is by the IMF and the World Bank. Number 2, it argued that banks should accept repayment of less than full amount of the debt, so as to accept repayment of less than the full amount. And then number 3, it called on the government of the developed countries, to amend their banking legislations, to provide for debt forgiveness in their banks according to rules or bank accounting rules. So those are the things. So let me take the number 3 again, that it called on the government of developed countries to amend their banking regulations to provide debt forgiveness in their bank accounting rules. So that is actually number 4. Then number 5, debt swap. Now, what is this debt swap? Debt swap is the exchange of debt with a number of options, such as debt for infrastructure, or debt for export, or debt for development, etc. All of these are actually known as debt swap. Okay, so thank you very much.